Can the Fed continue printing money today?
Yeah, so the Fed can continue. Again, it's very important to track the transactions. So when the Fed makes a purchase and prints money, it can expand its balance sheet, and it makes a purchase. The key is, are you getting the money in the hands of that person who's going to use it the way you want it to be used? So now, if you go buy a mortgage-backed security or you go buy a treasury bond and so on, it's probably not going to be good enough, because it now gives somebody, the owner of that treasury bond, they're going to want to buy something that's like a treasury bond because that's what they had before, or something like a mortgage. And that particular problem means, how do you get that into spending? It's a long way between that person who's holding that financial asset and a guy who's going to buy a car or a house.
Is that where we are right now?
That's where you are now, right? So the traditional dynamic of that is that in order for that thing to work, that there's central banks can buy financial assets, but they can't buy goods and services. Central governments, fiscal policy, can buy goods and services, but they can't print money. So the usual dynamic is to take money, make it purchased. I buy your bonds, treasury, I'll buy the government, and you will take that money and get that in the hands of people. So in order to be functional, if you hit an air pocket, I think that there's a good chance for here that we don't hit an air pocket. But it's very much like hitting an air pocket. The economy can probably grow at about 2%, maybe a little bit less than 2%, because it can grow at a rate that doesn't raise the debt-to-income ratio. So if you look at the feedback loops, basically somewhere in the vicinity of 1.5 or 2%. Anyway, so that could have that. And if we sort of coast along at 1.5 and 2%, okay, that becomes sort of a tolerable, maybe it's tolerable, that's the kind of thing. If you hit an air pocket, you have to have the stimulation. You can have monetary stimulation by the central bank doing that, but if they buy treasury bonds for people who buy something similar, it's not going to stimulate the economy very much because it won't buy cars and houses. And so you need then the fiscal policy, and then the question is, how does fiscal policy, because of the circumstances, the politics of it, the ideologies of it, how does it respond to that kind of circumstance?
I want to get back to this. I want to get some questions from the audience before we have microphones. Yes.
Mimi Barker, I wonder if you could talk a little bit about deflation, whether you see that as a real risk and what the consequences of that might be.
Yeah, I think that the natural way of things right now is much more deflationary, and so I'm looking at the world as a whole, and so I'm looking at China, Europe, the United States, the nature of deleveraging, and there's a natural move toward more deflationary pressures. Then there is the response of monetary policy. And so we look at, and I've just offered those sort of comments. Certainly, it becomes the mix of those.
You're not worried about inflation. You think we're in a deflationary environment for the foreseeable future. So does inflation become a problem 3 years out?
So I want to explain why. Rather than give you the answer, I want to explain the reasoning. There is a natural deflationary move having to do with deleveraging. Even China was in a bubble, and their bubble's bursting. So they have a domestic demand problem that's emerging. They have an export problem because they're going into a world that is also a problem. And they have an efficiency problem in terms of allocating capital and allocating spending. So they accounted for more than a third of the expansion since the low in 2008, the global expansion. So the world does not have a locomotive. We don't have a locomotive, and we have these deflationary pressures. That's the natural course of things. The purpose of monetary policy, effective monetary policy, and fiscal policy, if it's working, is to negate those things. And so the responsiveness, if it's kept in an orderly way, means that you don't go to inflation, you negate deflation. So in the Great Depression, there was a big expansion of monetary policy, and we didn't produce an inflation. So in various ways, fiscal and monetary policy can negate that. Those will be at odds, and so how it's managed really will very much be dependent on how policymakers run policy. So as we're dealing with those become the bigger questions, how you're managing those two things. I think over the near term, there's more deflation risk than there is inflation risk globally. I think over the long term, there's more inflation risk than there is deflation risk.
And the long term, 5 years? 10
5 years.
5 years.
Yeah, 5 years. And the key is in achieving balance. This is, again, the one thing I want to emphasize is balance is so important because there is a tendency to go extremes.